Okay, welcome to this video. In this video I want to share with you some candles and how you can trade them in the forex market. Basically, there are different candle formations that you may have seen or you will see in the forex market. The candles are not the same. Okay, some are individual candles, some are two candles, some even triple candles. Okay, and they are all saying something. It's either they are pointing us the new direction, or they are pointing to us a continuation in our direction. Okay, so I want to explain some of these candles to you. The list here is not exhaustive, but at least the major ones I want to explain to you and how you can look out for them at certain locations within your chart and trade them. Okay, so without wasting much time, let's go straight to the point. Now the first candle we see here is an inside bar. An inside bar is a candle that is usually formed within the body of a bigger candle. Okay, in this case we are seeing that the mother candle is a bullish candle. Okay, and now after this candle has closed, it still remains within the body of the bigger candle. That means it's inside of the big candle. And the color of the candle notwithstanding, this candle here can be red or it can be green, as we are seeing. It doesn't matter. What matters is that the current candle that has just closed has closed within the body of this candle. It has not closed above it or below it, but it's just within this candle. Now when you see this kind of candle at certain location within your chart, like a resistance area, it most likely pointing to the fact that the market is about to reverse the trend. Okay, it most pointing that the trend is about to reverse. If it were a bullish trend and then the candle appears, it shows that the bulls are losing momentum. Okay, so the market might likely begin to sell down. This is the meaning of this candle when it appears at a resistance area. Of course, if it appears at a support area, it could also mean a reversal to the upside. Okay, so it all depends on where the inside bar appears, or even at Fibonacci level. Okay, so this is another candle, a bullish hammer. A bullish hammer, as you can see, is simply a bull dominated section. Okay, because this candle you can see here was actually a bearish candle. It was red. It was a red candle, but pushed it upward, and you can see a handle and a hammer. Okay, it shows a bullish pressure in the market, and when this candle appears at a support area or a critical Fibonacci level, it shows the market is likely going to buy up. Okay, it shows that the bulls are in the market and they are willing to push the price to the upside. Okay, now the pin bar seems to be the opposite of the bull's hammer. Okay, the pin bar is a bearish candle that appears usually at the top of an uptrend. Okay, the market has been trending up and it got to a level, maybe Fibonacci level or resistance level, and the bears came in and pushed the price down. Okay, so when this candle appears, when you see this candle like this, either on the daily chart or a 4-hour chart, any other chart, is telling you a bearish pressure, and what to expect is you are likely going to see a reversal to the downside. Okay, a reversal to the downside. Now here we have another candle. It's a doji candle. A doji candle is an indecision candle. It's showing you that the bears and the bulls are not able to arrive at which direction the trend should go next. Okay, so there's an indecision, and what in the indecision period, what do? The market simply remains stagnant, and that is what you are seeing here. They push up by buyers and they push down by sellers, and this is where they are now. They have not decided where next the market will move next. Now what you should do is that when you see a candle like this, watch out for the next candle. Okay, watch out for the next candle. It might point to the new direction that the trend might just be going. Okay, now let's see. This candle is two candle here, and it's a bearish engulfing candle. It's a bearish engulfing candle because as we can see, the bears have engulfed the bulls. The initial candle or the first candle was a bullish candle, okay, and then the candle that followed next is a bearish candle, and as we can see, it has engulfed completely the body of the previous candle, which shows a bearish pressure that the bears are willing to push the price to the downside. Okay, the bears are willing to push the price to the downside, and that is why they're able to engulf completely the body of the previous bull candle. Now this is the opposite of a bearish candle. This is a bullish engulfing candle. Usually you may see this at a support area, okay, or at any pivotal area of Fibonacci level, and it's simply showing a bullish momentum, a bullish pressure that the bulls are able, or are willing rather, to push the price to the upside. Okay, so these candles themselves are not to be taken seriously if they appear just anywhere within the chart. You have to look at this candle at key areas. For instance, you should look out for this candle when price go to support areas. You should look out for this candle when price get to resistance areas. These candles may speak something meaningful that you might use in your trading or your entry decisions if they appear at certain Fibonacci levels or even pivotal areas. So you can't just see the candle anywhere and jump in. You should be able to locate them at areas, resistance levels, support levels, or Fibonacci levels. Okay, that is when the candle makes much sense. Okay, and as I have said, these candles are reversal candles or a continuation candles. Okay, it all depends on where they appear. Okay, it all depends on where they appear. They might be pointing to a reversal of the trend, or they might be pointing to a continuation of the trend. Okay, just pay attention to the location of the candle. Now I want us to go straight and look at the real chart and make a sense of all this.